Welcome to this masterclass on AQA topic 3.1.4. Today, we're diving straight into the foundational sources of finance, but we're going to look at it through the lens of a really crucial business framework, the risk versus control trade-off. In this explainer, we aren't just going to memorize a list of where money comes from. No, we're going to learn how to think like a chief financial officer. Because the truth is, every single financial decision a business makes is a highly strategic calculation. You are constantly weighing the cost of capital against the actual power you might have to give up just to get it.
Here's our roadmap for today. We'll start with internal sources of finance, then move to external sources, explore the risk control spectrum, look at a strategic application with Finlay's Farm, evaluate ownership and control, and wrap up by building Synoptic Strategic Links.
All right, part 1, internal sources of finance. We're starting with the funds generated directly from within the business itself.
Let's quickly rattle through the strategic pros and cons of these internal sources. Things like owner's investment and retained profits are incredibly attractive, right? They're effectively the cheapest sources of finance available. You're not paying a dime in interest to a bank, and crucially, you suffer absolutely zero loss of control over your company. But there is a catch. Their capacity is usually pretty strictly limited. If you're a startup or a rapidly expanding firm relying purely on last year's profits or just selling off a few assets, well, it probably won't cut it. You might turn to something like sale and leaseback, which does free up capital while letting you retain the use of the asset, but remember, that adds fixed leasing costs to your monthly outgoings. Basically, internal sources protect your power, but they can totally throttle your growth if you're in need of a massive cash injection. Moving on to part 2. External sources of finance. When the internal funds just aren't enough, businesses have to look outwards. And looking outward introduces entirely new strategic challenges. These external sources force leaders to choose exactly what they're willing to sacrifice for the sake of growth. On one hand, you've got short-term lifelines. Think trade credit and overdrafts. These are absolutely fantastic for cash flow and managing working capital, but they're completely inappropriate if you're trying to fund, say, a brand new factory. For that, you need long-term options. So you could take out a bank loan. You keep all your control, but suddenly you've introduced strict fixed interest payments. Alternatively, you could issue share capital or bring in private equity. Now, this unlocks huge capital potential and often brings in some invaluable industry expertise. But the trade-off, you are permanently diluting your ownership. And if your core objectives end up clashing with your new angel investor, that tension can literally paralyze the company's decision-making.
Which brings us nicely to Section 3, the risk control spectrum. This is really the core narrative of our masterclass today.
You have to navigate this constant tug of war, the strategist's dilemma. If you choose debt, like a massive bank loan, you maintain high control, simply because the bank doesn't get a vote on how you run your marketing campaigns. But you take on high financial risk, because that bank demands its interest payment every single month, regardless of whether your sales are booming or completely crashing. On the flip side, if you choose equity, like selling shares, you lower your financial risk since there are no mandatory monthly repayments, but you sacrifice your control. Those new shareholders, they now have a say in how your business is run.
To formally evaluate this risk, we use a sophisticated analytical concept called gearing. Gearing measures the extent to which a company relies on debt as opposed to equity. So, a highly geared business relies heavily on loans. This is a critical, absolutely crucial metric for long-term financial stability. High gearing means high fixed costs, which makes the business incredibly vulnerable to economic downturns or any sudden drops in consumer demand.
Let's put your analysis skills to the test on this exact concept. Pause the video now and complete task 1. Okay, Section 4, Strategic Application, looking at Finlay's Farm. Let's see how all this plays out in a real-world scenario.
Here we have a fantastic case study right from the source material, Finlay's Farm Ltd. Imagine a small organic family farm in Scotland. They make amazing cheese and ice cream, but they are facing some serious external threats. They're losing government agricultural subsidies, and post-Brexit export regulations have just become incredibly complex. To survive and actually grow, they want to diversify. Their plan is to open a glamping campsite, tapping directly into a market that's worth about £350 million. But here's the rub, their current financial position. To build these 8 luxury eco-lodges, they obviously need capital. However, the data tells us Finlay's Farm is already highly geared. They already carry a significant amount of debt. If they just casually stroll into a bank for another loan, the added fixed interest costs could completely wipe out their profit margins, especially considering demand for glamping is highly seasonal. But they do have a massive strength. They are an award-winning, ethical, organic brand with a fantastic relationship with their customers. And crucially, they have successfully used crowdfunding in the past. This is where you need to apply what you know directly to the specifics of their situation. Pause the video now and complete task 2.
Welcome back. Let's jump into Section 5, Evaluating Ownership and Control. We're going to elevate our thinking now, shifting from a small family farm to a multi-million-pound empire.
Let's look at how the examiners assess a high-growth context like Gymshark. When founder Ben Francis had these incredibly ambitious plans to expand Gymshark, the core evaluation wasn't just about getting the cash, it was really about the cost of control. As the sample mark scheme highlights, Ben previously retained 70% of his shares. This signals to an examiner that maintaining control is vital to him. Why? Well, because giving up control to outside investors risks serious clashes over the marketing vision and what the brand fundamentally represents to its community.
Think about it. If Ben uses private equity, sure, those investors might bring incredible expertise in opening physical retail stores or expanding into the Asian market. That's a massive positive. But private equity firms typically demand aggressive short-term financial returns. If Ben's vision involves slow, sustainable, long-term brand building, that clash of objectives is going to cause severe friction. It can stall decision-making and even cause key staff to walk out due to the tension. Alternatively, issuing more share capital avoids fixed interest, but successful shareholders are definitely going to demand high dividends. That drains retained profits that could have been reinvested for further expansion. Or he could take loans, which protects 100% of his control but drastically increases the financial risk if the expansion doesn't immediately generate the cash flow needed to pay that interest.
It's time to lock in those top-tier evaluation marks by weighing up these exact arguments. Pause the video now and complete task 3.
Finally, Section 6, Building Synoptic Strategic Links. To secure the absolute highest grades, we must connect finance to the rest of the business specification.
The very best answers in business studies don't just state isolated facts, they build logical, domino effect chains of reasoning. Look at this sequence. If a business chooses a bank loan, that leads to higher gearing. Higher gearing directly leads to higher fixed costs because of those interest payments. Higher fixed costs mean the business now has a higher break-even output. They literally have to sell more physical products just to survive the month. And finally, a higher break-even point results in a lower margin of safety. This right here is how you demonstrate sophisticated, multi-step analysis to an examiner. You are proving that a single decision in finance directly impacts the operational risk of the entire business.
Furthermore, your financial choices are deeply, deeply intertwined with other units you've studied. Think about legal structure. A sole trader taking on massive debt faces unlimited liability. Their personal home is literally on the line. A private limited company like Finley's Farm protects personal assets but restricts how easily they can sell shares to the public compared to a PLC. Or think about strategic change. If you bring in aggressive private equity investors who decide they want to completely overhaul the company culture, you might instantly trigger Cotter's resistance to change among your existing staff. Finance simply does not exist in a vacuum.
As we wrap up this explainer, I want you to keep this core dilemma in mind. Next time you look at a business in your exam, don't just see the money coming in. Look closely at the balance sheet and ask yourself, what exactly did they sacrifice for that cash? Are they choking on debt, or have they handed over the keys to their own castle? Thank you so much for joining me in this masterclass, and keep building those strategic links.